This video is based on two ACA training webinars produced by the Center on Budget and Policy Priorities. They've been edited to better match the dividing line between relatively simple ACA situations and those that are more challenging. The first video of this set focused on the basic ACA issues that most taxpayers will face. You should view that before watching this one. This video addresses some of the more complicated ACA situations. For the most part, this means exemptions due to taxpayer hardship and those based on health coverage that is unaffordable. Some unique premium tax credit situations are also covered. Even after viewing this, in some situations you'll still have to consult IRS publications. In addition to Publication 4012, you should try to become familiar with the IRS instructions for Forms 8962 and 8965. You may want to pause this video for a moment to copy a URL. It points to a document that discusses the complete set of ACA training webinars and has links to all of them, as well as to useful and sometimes necessary resources. This document will be updated as more training resources become available. This video was intended for a national audience, so in determining affordability, it uses the Federal Marketplace tool to look up plan costs. Here is a shortened URL that will take you to Covered California's lookup tool. I hope you'll find this video useful. Comments are welcome and can be sent to the email address on the screen. It will be available at the end of the presentation as well. Now let's get started on this advanced ACA webinar.
Okay, great. So let's dive into the affordability exemption. I was at a site last year because I am a VITA volunteer too, and I've been a site manager for many years. And I was at my first site where we had a lot of affordability exemptions, and it was definitely a challenge. So what we're going to do is we're going to talk through the affordability exemption and hopefully give you some tools that you can use and share with your volunteers. So the basics of the exemption is that we're looking at the cost of the lowest premium, and we're asking it whether it costs more than 8.16% of household income. Household income is going to be a pretty standard formula: AGI plus tax-exempt interest plus excluded foreign income plus dependent income only if the dependent has a filing requirement, plus any pre-tax deduction for employer-sponsored insurance premiums. Now, I'll give you a little warning on that. It can be tricky to figure out what the pre-tax deduction was in some cases, because sometimes people have multiple pre-tax deductions. One shortcut you can't use is box 12. There's the code DD that has the cost of coverage. That is not the cost of the pre-tax deduction, because the pre-tax deduction refers to the employee's share, and code DD also includes the employer's share. So you can't get it from that, unfortunately. Now, this actually hasn't come up in practice for me very often, because usually if one person is insured via employer-sponsored insurance, the rest of the family is, or the rest of the family is eligible for Medicaid or something like that. So it doesn't come up in every case, but that can be a little tricky to figure out. The first step in the affordability exemption is always to look at the cost of employer-sponsored insurance. And this is, again, one of my gripes with having that tax layer screen that goes straight to the marketplace affordability, is that even in the affordability exemption, you don't start there. You always start with the cost of employer-sponsored insurance. And first you start with a plan that person is eligible for as an employee. We're going to go through each person on the tax return, and we're going to ask, were you eligible for employer-sponsored insurance as an employee? What was your lowest cost self-only plan? And did it cost more than 8.16% of household income? If the answer is no, that there was no coverage offered to someone as an employee, then we're going to ask, were you offered coverage as a member of an employee's family? And did the lowest cost family plan cost more than 8.16% of household income? If the answer to that is no, that there was no, that the person was not offered coverage through, was not offered family coverage through an employer, then we're going to look at the lowest cost bronze plan premium and whether that cost more than 8.16%. So there's a hierarchy here, and you've got to follow it. And once someone sort of tests in one of these categories, you're done. So if I'm offered coverage as an employee, and it cost 9% of my income, then my answer is that I can claim that affordability exemption. I don't have to also prove other things, okay? But it works in the inverse too. If I'm an employee and my employer plan cost 8% of income, I can't then try out the other tests and see if they work better. So you just go in this order, and you stop when you have an answer. So let's work this out through examples. So we have Gregory and Alice, and they are married filing jointly. They live in Oklahoma City, and they are both uninsured all year with no other exemption. So I'm just telling you there's no other exemption. Gregory has box one income of $20,000. He was also offered insurance coverage. So he was offered coverage of $50 per month for himself. And he was offered family coverage of $350 a month. And it's not unusual for the self-only cost to be much lower than the family cost. Now his wife Alice, she had wages of $25,000 and she had no insurance offer. And they were both uninsured all year. So like I said, we're going to go through this hierarchy of questions. We're going to start with Gregory. And our first question to him is going to be, were you offered self-only coverage? And the answer here is yes. He was offered an employer plan for $50 a month. We're going to annualize that. So we're going to, 50 times 12 is 600. And we're going to compare that cost to annual income. And we're going to see that it costs only 1.3% of household income. So we're including all household income, not just Gregory's income, and we're always annualizing the cost. Even if we're looking at whether someone is eligible for an exemption for just 1 month, we're always using annualized costs. So in this case, Gregory is not eligible for Code A because his plan costs less than 8.16% of household income. Now let's look at his wife, Alice. She has no offer of coverage through her own employer. So that was our step one. Do you have an offer of coverage through your own employer? She says no. So we're going to ask, do you have an offer of coverage through someone else's employer? And the answer here is yes. She has an offer through Gregory's employer for coverage at $350 a month. Now, we just keep the $350 a month. Yes, that would include Gregory, but we're not subtracting out Gregory's $50 cost or anything like that. We just use the flat cost that they offer family coverage for. So we're using $350 per month. Multiply that by 12, it's $4,200. We're comparing the $4,200 to their annual income, and we find that it is 9.33% of household income. So Alice is going to be eligible for the affordability exemption because her offer of coverage is greater than 8.16% of income. Now let's change it up a little bit, and let's say that January through June, she had no insurance offered at work, but July through December, she does enroll in coverage at work. We're still using, all of this is the same as the last slide. We're still using the annualized cost of coverage. We're always, and this is the one thing when I was initially learning this that I had the most trouble getting, which is we're always using the annualized cost of coverage because we're always using the annual income. We're not saying, okay, what did they earn in January? What did they earn in February? What did they earn in March? Can you imagine how hard that would be with some of our clients with a waitress or someone who has 3 part-time jobs trying to figure out what their monthly income was? No, you don't do that. So we just look at what their year-end income was, and we compare that to the annualized cost of coverage because we want an apples to apples comparison. Okay? And you'll get a little bit of help sometimes because in learning the cost of coverage, because most people will, if they're offered coverage, they'll get a 1095-C, they should. And this is something given by large employers only, and it will say not just whether someone enrolled in coverage, but also what the employee's contribution was and whether they were offered coverage. So this gives you a lot of important information. There are a ton of codes used on this form, so you'll definitely need to flip it over, read the back, or Google, find the IRS pub for this and understand what the codes mean. But line 15 is going to list the employee's share of the lowest cost plan for the employee. It's not going to give you the cost of a family plan, but it might help you out at least in some of these calculations, because people, of course, it's really hard for people to remember what their coverage costs. That coverage that they didn't take 15 months ago, what did that cost? That's more than half the battle figuring that out. And if there is no 1095-C, it's actually not a hard thing usually to ask for the Human Resources Department to come up with a previous year plan cost of the lowest cost plan. This is something that they have readily available. It's easier than some of the other questions we might need to ask them. So it's worth it to have an employee ask at their job to see if they can claim this exemption. And the 1095-Cs, I think, will start to get a lot better, because there was just this headline in the New York Times: the IRS starts to enforce health law's rule that employers offer insurance. So the IRS is now sending out notices from 2015, yes, 2015, to employers whose employees qualified for premium tax credits, saying, why weren't you offering them affordable coverage? So those letters are going out now. So I think the quality of the 1095-Cs might get a little better. Okay, so we have gone through all of the lettered exemptions. We have determined the affordability of a self-only employer plan, of a family employer plan, and now we can finally, after 50 minutes, use this screen that TaxSlayer presented first. Do you qualify for a marketplace exemption? So to do this, we're going to need to find the lowest cost bronze plan and the second lowest cost silver plan. And you'll find these things at healthcare.gov/tax-tool. That's tax-tool. In other states, if you have a state-based marketplace, it's a real grab bag what you have in your state available to get the same information. But we're going to provide, like we did last year, a list of links so you know where to get it if you have trouble finding it. Okay, so more on lowest cost bronze plan and second lowest cost silver plan. What are these things? And what do we mean when we say worksheet line 1? What worksheet? Where? When we talk about line 1, it's line 1 of the Marketplace Coverage Affordability Worksheet. And that in the 2017 instructions for the 8965, it's page 11. Line 1 is the lowest cost bronze plan, and it's going to include everyone claimed on the tax return who is not eligible for employer-sponsored coverage and who is not eligible for another exemption. So this is going to mean that you're going to include household members that have Medicaid or Medicare coverage, because there's no exclusion for them. We're only excluding people who are not eligible for employer-sponsored coverage. They can be enrolled or eligible for other coverage. Now, the same is not true for the line 10, second lowest cost silver plan. For that, we are looking at everyone claimed on the tax return who is not eligible for any other MEC other than coverage in the individual market, and who is not eligible for another exemption. So we've got a more limited pool in line 10. Now, if you are using the healthcare.gov tool, if you're in those states that allow you to use that, then you will be walked through these definitions, because they're just going to ask the question in a straightforward way. If you are using a state marketplace tool, you will really need to do the work, because most of the tools either, don't give you any help with knowing who you are looking for plan costs for, or in some cases they give you bad instructions. And we're going to contact those entities again and see if they can offer correct information this year. So let's look at an example. This is Max. He's single, no dependents. He was uninsured before getting a job with coverage starting April 21st. He lives in Arlington, Virginia. He made $17,500 in 2017. So first, we're going to figure out, what are we looking for? Let's figure out coverage versus exemption months. So he's covered April through December because he had some coverage in April, so that's good enough. So we're looking for an exemption for January through March. Then we're going to think about, do any easy exemptions apply? So does he qualify for a short coverage gap? No, because the exemption was 3 full months, and you need to have a gap of less than 3 months in order to qualify. Does he qualify for income below the filing threshold? No, his income is too high. Medicaid coverage gap, he lives in a state that did not expand Medicaid, but his income is above 138% of FPL. Okay, well, and no other easy exemption seems to apply. So it's time to consider the affordability exemption. And first, did Max have an offer of employer-sponsored coverage for the months of January through March? And the answer was no. He didn't for those months. He did later, but not for those months that we're looking at. And so we're going to consider the marketplace affordability exemption. So you're going to start at healthcare.gov/tax-tool. And then, as I said, it's going to walk you through the eligibility and you sort of make some of those line 1, line 10 rules a little easier. So it asks, for each family member, were they eligible for employer coverage or had another exemption? So he was eligible for employer coverage April through December, and eligible for, even if he did not enroll in it, we would still say he was eligible for coverage April through December. So I'm checking those boxes. And then in the next step, it blurs out those boxes because it already has the answer it needs for that. And it's asking for January through March, is that family member eligible for coverage outside the marketplace, like Medicare, Medicaid, CHIP, or an employer plan? And the answer is no, so I'm not checking any boxes. And then after you go through some other screens that talk about or that ask about your zip code and who lives with you, other dependents, et cetera, you're going to get to a screen that just spits out numbers of the lowest cost bronze plan and second lowest cost silver plan. And then you're going to put them into the TaxSlayer page that asks for those values. And then you're going to get this page that asks if you qualify for an exemption, and it's going to, at that same page, spit out the determination that based on the marketplace coverage affordability worksheet, you qualify for the unaffordable exemption. Actually, he doesn't. So that's a problem. So the calculation right now in TaxSlayer is just wrong. I don't know the parameters, if it's always wrong or a little wrong, or, I mean, it's really wrong. So I wouldn't rely on that right now. Hopefully they will clean it up by the time we're live. The other problem I have with this is that it says, would you like to apply the unaffordable exemption to all household members? Well, if you were to click that, let's say you had a family of 4 and one person was uninsured and testing this exemption, this would give an exemption to all 4 people, even if the others had insurance. So, so that doesn't work either. So there's still a little bit of work to do, and I'm sure that this is a work in progress from TaxSlayer. But just as proof, in case you didn't believe me that he doesn't qualify for an exemption, I just plugged into the marketplace affordability worksheet the values that we looked up. And you can see the result of this worksheet is 0. So what does 0 mean? 0 means that this is the annualized required contribution. That means that Max could have enrolled for the lowest cost in the lowest cost bronze plan for free. But he chose not to, and it would have been free because it would have, because he would have been eligible for premium tax credits that would have brought the cost down to 0, the annual cost down to 0. So he does not get an exemption. Now, just for the sake of argument, let's imagine that that the annualized required contribution at the end of this worksheet was $700. I just want to make a point about why we're using annualized numbers. So his affordability threshold, the 8.16% of income, is $1,428. So just sort of put that in a column for January, February, March. And the value that we're going to test is the $700, the annualized required contribution. We're not testing a monthly contribution amount. Why? Because we're looking at the annual income amount. So we can't test a monthly amount against an annual amount. So we use the annual amount for both. Okay. Now, one other option is to use a tool, a marketplace affordability tool, just to do some of the math for you. We have one. There are other great ones out there. I have the URL for our tool. We're going to update this for 2017, but we haven't yet, or we haven't uploaded it yet. And I think we're going to turn this into a web-based tool rather than an Excel sheet, so it should be much more usable. But there are lots of great tools out there, so it's worth finding one. Now, quickly, let's go through another example. I know we're up on time, but I think that this affordability stuff is really important. This example is particularly important for people who are in states that expanded Medicaid. Just because you expanded Medicaid doesn't mean everyone enrolled. So this is Summer. She's single, no dependents, lives in California, which expanded Medicaid. She's uninsured. She made $13,000 last year. Now, I'm just telling you her lowest cost bronze plan is $166. Does she qualify for an exemption? The answer is going to be yes. And that's because her second lowest cost silver plan is $0. Why is it $0? It's $0 because she qualifies for other coverage. She qualifies for Medicaid. And so that zeroes out the second lowest cost silver plan, and that means she would get $0 premium tax credit. For most people, in most circumstances, if they're getting $0 premium tax credit, they're going to be eligible for this exemption. Now, you should still do the math, but it's really a shortened math because we're just looking at the lowest cost bronze plan, and then we're multiplying it by 12 to get the annualized amount, and then compare it to income, and you'll see that it was well over 8.16% of income. So the insurance is unaffordable, and you're going to claim the exemption. A person is going to be most likely to qualify for the affordability exemption if they're eligible for Medicaid and not enrolled, people like Summer. Or if they're ineligible for PTC for other reasons, like because they're married filing separately. A person is often not going to qualify for this exemption if they have income just above 138%. And that's because the premium tax credits are the most generous there. And so it's hard to make insurance look unaffordable mathematically, so you need to look for some other exemption. Results may vary, especially in states that have tobacco rating, and it's a long-winded explanation, but if you have someone who's a tobacco user and you're in a particular state where they can vary plan costs by whether someone is a tobacco user, then the premiums, this formula gets a little fuzzy, but more generous, skewing toward more people being found to have unaffordable coverage and qualify for exemption. The bottom line is that you're going to need to do the math. We're going to wrap up just by talking, reminding us we're not quite done yet with exemptions. We still have the marketplace exemptions. These need to be applied for via the marketplace. There are hardship exemptions that are particularly relevant to the population that we serve through VITA and TCE, and people who have utility shutoff notices, who are facing eviction, who have experienced bankruptcy or medical debt, people who have been part of a disaster that resulted in significant property damage. Think of all the storms and fires and floods that we've had in the last year. So those are some common reasons for hardship exemptions, but you need to submit an application to get them. If someone submits an application but they haven't gotten it approved yet, then you can type the word pending to indicate that the exemption was applied for. The exemption certificate numbers are sometimes 6 digits, but the software requires a 7-digit number. So if it's only 6 digits, just add a 0 to the beginning or the end, and it should go through. And my parting shot here is always look at line 66 or line 61. And that's because you just want to be sure that people aren't paying a penalty that they don't owe, and that you've really exhausted every possibility for exemptions that you can think of and that your neighbors can think of to avoid penalty, because it really does take a bite. So we want to do our best. And, quality review, if you look at line 61, you can often pick up, some pretty simple mistakes that people made that cost someone this exemption, or that cost someone an exemption and made them pay a penalty. The shared responsibility payment is owed if a person does not have coverage or an exemption for a month. It is based on a formula. We're taking whichever is greater of these two things, either a flat amount of $695 per adult or a percentage of income of 2.5% of household income over the income tax filing threshold. So the greater of those two amounts. Now, it is a formula that's indexed by some kind of cost of living adjustment, but the numbers actually didn't change from last year, so it's the same figures as last year. So here is what the shared responsibility penalty looks like for a person who is single. You'll see at the bottom left of your screen, there's a period for the lowest income people where they have paid no penalty. And then there's this big jump up where people start to pay the penalty of $695. I will say this is a little misleading, because the only exemption we were looking at here was for income below the filing threshold. That's where we drew the line here. But there are other exemptions that really do help people who are just right above that no penalty mark. In particular, the exemption for people who are in the Medicaid coverage gap in a state that did not expand Medicaid, and people who are in a state that did expand Medicaid, but who were not enrolled. So there's another substantial proportion of people who are above the no penalty mark, but are not paying the $695 penalty. And then you'll see around $38,000, that's where it switches over to 2.5% of income, because we're taking the higher of the two. And remember that the penalty is calculated by month. And so if you have 7 months insured, as this person does in this example, then the calculation that the tax software is going to do for you is to look at the monthly calculation based on both formulas, and then take the higher of the two. So the amount is prorated by month. Tax-Aide does give you an awful lot of information about the shared responsibility payment. They give you 5 pages of toner that you'll never get back. So the first 3, there's a lot of words there. No one's going to read them. I do find the 4th page to be fairly useful, because on the left side of this worksheet A, it tells you which members of the family you are calculating a penalty for, which is good, because maybe you have one thing on the intake paperwork and you had a conversation about another thing and you just kind of got confused in the back and forth. So this worksheet will tell you which members of the household you are calculating a penalty for and for which month. So that can be useful. And then page 5 tells you whether the program has taken the flat amount or the percentage of income amount. So you can see in this example, the flat amount was $695 and the percentage of income amount was $404, and then the larger of the two is $695. So if you do need to have give a client an explanation and really, if they want to really talk through it, how it works, this is a useful page. My first stop in looking at doing review is looking at line 61, because this is where any penalty would be indicated on the tax return. This is also where you have an indication for full year coverage. That box would be checked, but I always flag line 61 when there's a client who has a slightly more complicated situation. Finally, we're going to go over some review tips. These are the things that I look at when I'm reviewing a return, especially a return of someone who's not very confident on these issues. So I'm going to look at, first I'm going to look at line 61 to see if there's a penalty amount and to see if I understand where that came from. That's always my starting point. Line 46 will show you the excess advanced premium tax credit. So this is the amount that someone will pay back on their tax return. The line 69 is the net premium tax credit. So that will be the amount that someone will get. Okay, next. Always preview the return because it'll give us all the other groovy forms. There's a lot to look at on Form 8962. Starting at the top of the form, if someone is married filing separately and PTC is disallowed, does the taxpayer qualify for an exception? So you would look for this check mark to see if they qualified for spousal abandonment or domestic abuse. If you have someone who was married filing separately and they don't have a check mark there, they're going to be repaying the whole amount up to the cap. So it's a good time to review whether they're eligible for that exception. Dependent income. They've changed the look of this form just a little bit this year. Dependent income is on 2B. And so, are we entering dependent income appropriately? Does this dependent have a filing requirement? If you see a number there like 1,000, then I would ask whether that is correct, because we know that you need income in excess, dependent income in excess of what, 6,350, I think, in wages to have a filing requirement. So you want to investigate that a little bit more and see if they really had a filing requirement. Moving down to line 6, which is where we have the FPL and the exception for people who have income below 100% of the poverty line. We talked about this extensively, but if yes is checked, it is probably wrong. So that's because a taxpayer can claim the premium tax credit with income below 100% of FPL if they received APTC or are a lawfully present alien who's not eligible for Medicaid. If income is 401%, so if income is over 400% of the poverty line, then yes, the taxpayer does have to repay all APTC, and that box is appropriately checked. But in many, many cases, that the answer to that is going to be no. Okay, so check that before you just sign off on full repayment. But also, if someone does have income over 400% of the poverty line, sometimes you can consider some other things. So if it's a married couple, have they considered filing separately? Because yes, they would be ineligible for the premium tax credit, but they would also get a repayment cap, which they don't have if they have income over 400% of the poverty line. So consider whether, and there are a lot of downsides to filing separately, which you need to account for. But consider whether it's worth it financially for them to file separately. You can also consider adjustments, such as making a deductible IRA contribution, contributing to a health savings account, taking tuition and fees deduction instead of an education credit. Moving down the form again, this is the part with shared policy allocations, which, as I said before, we can't really talk about because we can't do in TaxSlayer. So just be on the lookout. If someone has a 1095A that has some spare people and you don't know who these people are, they're not on the tax return, then you've got a shared policy allocation and you're not going to be able to do that tax return. That's going to be out of scope. Moving down to the, to the monthly amounts, as we talked about, there is, if you see a blank number in column E, which is the monthly premium tax credit allowed, do you understand why there was no tax credit allowed during this year? Or was this something, or was this like a mistake? So this might be a case where someone paid a premium and they got a monthly credit, but for some reason there's no SLIC SIP. And if there was a monthly second lowest cost premium entered, then they would probably calculate a benefit for that month. So do you understand why there's no SLIC SIP? Is there a reason for that, or is this just an oversight? And then look down to line 29. This is what I explained before. You can see on line 28, it's blank. So if you ever see line 28 blank, ask questions, because if this person is not over 401% of the poverty line, then there really should be a number in there, because some repayment cap should apply. So why doesn't it? Did you answer all the questions correctly? Was there a problem with one of those questions that took away the repayment limitation? If someone does have a high repayment, it's a sort of gut-wrenching situation, but there are some things you can talk about. First, I usually determine why the taxpayer's advance payment was too high. Maybe the 1095A is just wrong. So start there. Does the 1095A make sense to you? If not, let's figure out what's wrong about it. Let's call the marketplace. Maybe they made an error at the beginning of the year in estimating their income or their dependents' income, and that meant that they had a high repayment on their tax return. Maybe there was some error in calculating family size. So when they were asked in the marketplace how many people were in their family, they weren't really familiar with the tax rules and they couldn't figure it out. And the number they gave wasn't actually the number of members that are in their tax family when you use the correct dependency rules. Has their filing status changed? So maybe someone was head of household when they submitted their application, but now they're single, or maybe they were single or married, but now they are married filing separately. Has a dependent joined or left the family? That is going to change their position on the federal poverty line, which is going to change their premium. Encourage taxpayers to take less than the maximum APTC in future years. So, if you're determined eligible for $400 a month in credit, what if you took $350 a month and just gave yourself that wiggle room? Could you still pay your premiums if you took less in assistance in advance? You can also remind taxpayers that they need to promptly report changes in income and family size. So it might be that someone started out with information similar to what they told the marketplace, but then they got a new job and they never told the marketplace about the new job. And now they have more income and it wasn't accounted for in the premium tax credits, and now they've got to repay. And if you do have someone who has a large repayment, if they're still enrolled in marketplace coverage for 2018, encourage them to report their most recent income and dependent information, so they don't have the same problems in their 2018 reconciliation that they did in their 2017 reconciliation. So it does help to be a little proactive in encouraging people to use this information and what they've learned about household and family size and income to improve the accuracy of their 2018 marketplace projections. Finally, a few issues. Many taxpayers last year received a letter 12C to request more information. This occurred when someone received premium tax credits according to IRS information, but didn't reconcile them on their tax return. So either they forgot to include Form 8962, or there was some major problem with the form, and the IRS is asking for more information. Generally, that was a 1095A, a Form 8962, and page 2 of the 1040. So, it calculates the math correctly with the insertion of the 8962. This is usually just resolved through submitting that extra documentation. But in case someone didn't respond, or if their response was inadequate, their return may have been sent to exams for review and assessment. So someone may have their return kind of stuck in the system if they failed to respond, or if they didn't give enough information when they did respond. It's important for people to know, and they'll be getting letters to this effect if they haven't already, that if they didn't file for 2016, they might lose their APTC for 2018. And that's 2016 being the most recent filing year before the determination of the 2018 credits. If a person did not file in that most recent tax year, then they can lose future APTC. And without advanced premium tax credits, many people can't afford the full premium. This is especially true this year when premiums in some parts of the country have gone up. And so if someone has not filed that back return, consider helping them file prior year return early in the season. I know many programs like mine try to push people off until March when it slows down a little bit and do a prior year return then, but time may be really important here. And so if you can help someone file a prior year return earlier in the season, that might help someone maintain their health insurance coverage. Next question was, if you're measuring the affordability of employer-sponsored coverage to determine eligibility for the Code A exemption, does an offer of COBRA or retiree coverage count? And the answer to this is no. COBRA or retiree coverage is not going to count as an employer offer unless the eligible person actually enrolled in coverage. So for example, if a person is offered COBRA, it's very expensive, and so they didn't enroll. And they just didn't enroll in any coverage, and so remained uninsured for the year. If we're testing eligibility for the affordability exemption, that person is not going to be considered eligible for an employer offer, even though they had that offer of COBRA. And that's because COBRA and retiree coverage are treated differently than regular employer coverage. So assuming that person was also not eligible for other employer coverage, then we can move on to the marketplace affordability part of the Code A exemption. And his exemption for eligibility is going to be determined by the affordability of marketplace coverage after taking into account the premium tax credit. And someone with an offer of COBRA or retiree coverage can claim the premium tax credit as long as they didn't take up the COBRA or retiree coverage. So those rules get a little complicated and a little specific, but that's the rule.
Going back to one of the complex examples for someone who failed to pay a premium, so in the Form 1095A, that monthly enrollment premium is blank, but the second lowest cost silver plan is there, and the advanced premium tax credit is also there. So the first column is blank. The second two columns have something in them, and someone can pay that premium for that month so that they don't have to repay the advanced premium tax credit. How would you handle that with the 1095A? Would you write in the the monthly enrollment premium into the 1095A, or how would you handle that with the forms?
So with the form, I would probably just for my own notes write in the premium amount for that month, but also it's important that they seek a new 1095A. It might be triggered automatically by the payment made to the insurance company, but probably not. So I would definitely have them call the marketplace. And this is less for filing the return and more about reconciling the records between the marketplace and the IRS. because if there is some discrepancy there, then you're going to get a 12C letter, or you're going to, get into some other correspondence with the IRS where they say you're wrong because our records say you're wrong. So once they pay that premium, you're going to want to close the loop by getting a new 1095-A that reflects the fact that they paid the premium. But again, I don't think you need to wait for that to do the return because you know what it's going to say. But they will want to close the loop on that as part of the tax return process. I'll also say that our examples showed the advanced premium tax credit being, roughly half of the premium, or being equal to the premium, being equal to the enrollee's premium and roughly half of the total premium. But in most cases, that is not how it works. In most cases, the APTC is much larger than the amount that the enrollee has to pay. And so if it made sense to pay in the examples we gave, it really makes sense to bring this option up to someone who has a very high APTC and a very small premium, because repaying that high APTC might be a real burden, but compared to paying the enrollee's share of the premium. So keep that in mind.
Perfect. And then someone had a question. I thought I heard that if you wanted to file an amended return to address Form 8962 or 8965 type issues, that the IRS had said don't file a 1040X, just write a letter explaining. So for example, if you paid a penalty and now want to request a refund, you would just write a letter explaining this. So do you need to file an amended return, or is just a letter sufficient?
That's a good question, because I think the guidance on that has changed over time. I would say that if you're answering a 10C or a 12C letter, definitely don't file a 1040X, because if you got a 12C letter, that means that your return has been stopped. So it hasn't actually been processed, so you don't need to amend it. You can just send in the information that it's asking for, and that will be part of your original 1040 filing. I think that if you have some other issue, I think it's still recommended to file an amended tax return. I can check on that, but as far as I know, for sure, if you get a 12C letter, don't do an amendment. Just do just send in the information that they're looking for, and that will be a part of the original 1040. We'll talk a little bit about overlapping coverage, but I'll just give you a heads up that these rules are complicated, and I wouldn't expect anyone to just know them. But what I'm hoping to do is just, create this little tickle in your brain. So when you hear something that sounds like overlapping coverage and you're trying to figure out how do I avoid making this person repay all of this tax credit, that you'll think about these exceptions and go look them up. And when I say go look them up, I think the best place to go is not the form instructions, but this URL I have at the bottom of the page. That's a very useful and detailed document. It's meant for tax professionals, but it contains some information that you maybe won't find elsewhere, and you certainly won't find in the instructions. So here are some of the exceptions where people can claim the premium tax credit despite being eligible for other minimum essential coverage. So in general, people who are eligible for premium tax credits on the first day of the month are considered eligible for the full month, even if they become eligible for some other coverage during the month. So, you're allowed that month overlap as you change from premium tax credits to, say, employer coverage, or premium tax credits to Medicaid. You're allowed that overlap. If a person is enrolled in APTC but is later determined eligible for Medicaid, there is a more expansive allowance for overlap. So premium tax credits are allowed for retroactive Medicaid. So if you apply in April and they determine that you were eligible as of January, then those 3 months of retroactive Medicaid, you can still claim the PTC because, well, how are you to know you were going to be determined eligible retroactively? But a person is also generally eligible for the premium tax credit for the entire calendar year, even if they've also are enrolled in Medicaid for some of those months. So keep that provision in mind. In some cases, people, are enrolled in premium tax credits. They have some change in income that makes them eligible for Medicaid, but the paperwork kind of gets lost between Medicaid and the taxpayer in the marketplace, and the person ends up staying in a marketplace plan with PTC and never quite effectuates, they think, the coverage in Medicaid. So there are some examples like that where there is some real administrative confusion or confusion on the part of the taxpayer where there is this extra allowance. So keep that in mind. More exceptions. If someone is eligible for Medicare, they lose premium tax credits even if they fail to enroll in Medicare. So just becoming eligible can cause a loss of eligibility for premium tax credits. But the loss of eligibility for PTC doesn't occur until the first day of the 4th full month after the person became eligible for Medicare. This is where I said you don't need to memorize all of this. And here's the example. Freddie is enrolled in marketplace coverage with APTC. His 65th birthday is May 17th, and he becomes eligible to enroll in Medicare. So if he continues in the marketplace with APTC all year, he's going to owe back September through December. So he became eligible in May, then we count out 3 full months, June, July, August, and the beginning of the fourth month, he is not eligible for premium tax credits anymore. So he would owe back APTC for September through December. And also, when he enrolls in Medicare Part B eventually, he's going to pay a higher premium because of the delayed enrollment. There are also some special provisions about overlaps with employer-sponsored coverage. First, let's just establish the rule. In general, a person is not eligible for premium tax credits if they have an affordable minimum value offer of coverage from an employer. If it's a large employer, you'll get a form that helps you figure this out, Form 1095-C. And it will have on line 14 information about the offer, and it's going to do it in letter codes. So you'll be prepared to sort of turn over the form and check out all the codes. And line 15 will give the cost of coverage for a self-only plan. So if it's an affordable offer, line 14 is going to say 1A, or it's going to have a different kind of code, and the cost of coverage on line 15 is going to be needs to be less than 9.69% of income. And remember that this is only the cost of self-only coverage. This doesn't give you information that will help you determine the affordability, typically of family coverage. But there is a safe harbor. So if a taxpayer told the marketplace that they had an offer of employer-sponsored coverage, and what the offer was, my insurance at work cost this much, and the marketplace awarded APTC anyway, then the taxpayer can claim the PTC. So basically, we're not holding the taxpayer responsible for the marketplace's mistake. So to solicit this information, you can ask, did you provide accurate information about the cost of employer-sponsored coverage? And if so, and the person received APTC for those months.
I hope you enjoyed this presentation. With luck, there will be follow-up webinars to both of the CBPP videos that will focus on ACA resources such as the Bogart Affordability Calculator, obtaining quotes from Covered California, and entering data into TaxSlayer. Here's a link to the document that gives all the links related to this training set. It will be updated as more training resources become available. As I mentioned at the beginning, your comments are welcome. Have a great tax season.